Yesterday, the euro came back under pressure, weighing down by weak Eurozone PMI numbers. Germany's manufacturing PMI fell to a three-month low of 43.2 in July from 43.5 in June, remaining well below the 50-point threshold that separates growth from contraction. As for the British currency, it plunged by 100 bips even before the Bank of England announced its monetary policy decision. The regulator cut its bank rate by 25 basis points to 5%. The focus of market participants was on BOE Governor Andrew Bailey's statement. He said that the central bank would be in no hurry to lower interest rates and that the next decision would also be based on income and statistics. Most importantly, Bailey noted that the key interest rate would not go back to near zero. His comments supported the pound sterling and allowed it to recover briefly. However, its bullish run was short-lived as the British currency resumed losses and even hit a new one-month low. Traders also digested data on manufacturing activity in the United States. The manufacturing PMI fell to 46.8 in July from 48.5 in June, with a reading below 50 indicating contraction. However, markets shrugged off the report and demand for the greenback persisted. While there is no reason to expect a rally in risky assets in the near term, things could change amid a batch of statistics. Today's macroeconomic calendar includes U.S. unemployment data. Notably, the unemployment rate has been on the rise since March 2024, climbing to 4.1% from 3.8%. In July, the indicator is forecast to remain unchanged at 4.1%. A higher figure could heighten an expectation for a rate cut in September. The nonfarm payrolls report is expected to show that the U.S. economy created 176,000 jobs in July, after having added 206,000 in June. If the data disappoints, demand for the dollar will ease by the end of the week, allowing the risky assets to recover. What is more, traders may take notice of data on industrial production in Italy and France, as well as the speech by Bank of England chief economist Hugh Peel. From a technical perspective, the EUR USD chart shows that bulls need to regain control of 1.0808. A rise followed by a false breakout at this mark will generate a sell signal, dragging the euro down to 1.0783. If the price breaks below this level supported by upbeat US labor market data, the European currency is likely to extend weakness to 1.0761 and 0738. At the level of 1.0738, I recommend going long on a rebound to catch an intraday correction of 20-25 pips. Long positions at 1.0783 and 1.0761 can only be considered amid a false breakout. In a bull case scenario, if the price breaks above 1.0808 and US data turns out to be downbeat, the euro will have a chance to climb to 0.830 and even 1.0850. At the level of 1.0850, it will be possible to go short on the rebound, expecting an intraday correction of 15-20 pips. Going short at 1.0830 and 1.0808 will only be relevant after false breakout. Speaking of the British pound, it's clearly in the bear market. A rise followed by a false breakout at 1.2755 will make it possible to sell the pound-dollar pair. Going short on the rebound is possible at 1.2791 or 1.2824. However, such a significant bullish correction is only likely in the event of a sharp shift in market sentiment. Going long is quite risky. Long positions can be considered at 1.2715 in anticipation of a bounce to 1.2755. If the price breaks below 27.15 on the back of strong US data, sterling is likely to dip to 1.2679 and even 1.2640. At the level of 1.2640, it would be a wise decision to go long on a rebound to catch an intraday correction of 35-40 pips. Going long against the trend at 1.2715 and 2679 will only be relevant after a false breakout. Good luck and have a great weekend.